A derivative is a financial contract with no value of its own. It derives its value from an underlying asset. This is Chapter 1 of the Futures and Options module, and everything here is education rather than advice. Value borrowed, never owned. That is the one sentence to carry out of this chapter. Underneath, the verdict. A derivative's value derives from an underlying asset, and it has none of its own. There it is on screen. The derivative is a dated claim on price, and it prices off the underlying asset, which is the only real thing in the picture. Why it holds? With no underlying, there is no contract. When the asset reprices, the contract follows. And when the contract expires, the asset lives on. So analyze the asset first, because the contract only translates that move into profit and loss. Study the asset. Study the underlying rather than the ticker of the contract, because the asset is where the move actually happens. So what is being borrowed? A contract has no price of its own. It prices whatever asset sits underneath it. Value is borrowed, not owned. Look at the two layers. The contract layer is quoted separately. A June future at 5,010 and a quarter, up 0.2%, and a June 5,000 call at $42.60, up 9.1%. Both derive their price from the layer below. That layer is spot at 5,000, and the underlying is the index itself. The core idea. It has no value of its own. A derivative is a contract, and its price is a function of the asset named inside it, and of nothing else. When the asset moves, the contract reprices. When the contract expires, the asset does not. And no shares move, because you are trading exposure. A stock is ownership, while a derivative is a dated claim on price. Nothing is owned. Trade the contract and you still own nothing, because every cent of its value is borrowed from the asset. So why do these contracts exist at all? Derivatives exist because one trader wants certainty and another is paid to take the swing. Risk changes hands, and both sides want it. Two customers, one market, and price risk between them. On one side, the hedger, who owns the asset and wants a known price rather than a bet. On the other, the speculator, who owns nothing and accepts the risk for the payoff. The exchange sits between them. The hedger gives up upside. The speculator takes the other side, and premium changes hands. 3 uses follow. Hedging is insurance. Lock tomorrow's price today and stop worrying about it. Speculation is leverage. Express a view with a fraction of the capital. And price discovery is information. The contract quotes what the crowd expects next. Why they exist. Risk changes hands. A derivative moves a risk from someone who does not want it to someone paid to hold it. The hedger buys certainty. The speculator sells certainty. And the market prices the trade. With no speculator, there is no hedge, because the cover exists only because someone will sell it. Not rivals. Hedgers and speculators are not rivals, because neither can trade without the other showing up. That is worth its own verdict. Both sides need each other. That is the second verdict of this chapter. Underneath, the verdict. Futures and options exist for hedging and speculation, and both sides need the other. There they are. The hedger sheds the risk and pays for calm, while the speculator takes the risk and wants the payoff. Why it holds. Hedging ensures a position. Speculation funds the insurance. And liquidity is the byproduct. A market with only hedgers would have no one to sell to, so it would not price at all. Two halves. Hedging and speculation are two halves of one market, and removing either side breaks the price discovery. So how do the two contracts differ? One is an obligation, the other is a choice. Both are contracts on the same asset, but the deal each hands you is not the same. Payoff shapes at expiry. Here are the two, the future as an obligation and the option as a choice, with the entry marked on one and the strike on the other. Below them, the outcomes. Price falls or price rises against the future, and price falls or price rises against the option. The difference is in the shape. The future is symmetric, giving the full move either way. The option's loss is capped at the premium paid, the deal you sign. A future must settle at expiry. Its cost is margin marked daily, and its loss is uncapped in both directions. An option may be exercised or walked away from. Its cost is premium paid up front, and the buyer's loss is that premium. Same view, different contract. The future demands, and the option offers. Demands or offers. A future commits you to the price, while an option sells you the right to change your mind. And every contract has two sides. Every contract is a two-sided deal. Your payoff is the exact mirror of the person who took the other end of it. The payoff is mirrored and zero-sum. Here it is drawn out. The buyer is long and the seller is short, with the strike between them. The premium is paid by one and kept by the other, and as price falls or rises, the two outcomes mirror each other exactly. Every cent one side gains, the other side pays, and there is no third outcome. Who you trade against. A hedger owns the asset and buys certainty. A speculator pays for exposure and takes the swing. A market maker quotes both sides and keeps the spread. And an arbitrageur trades the mispricing rather than the view. You trade whoever wants the opposite risk and rarely a rival. Ask who is opposite. Before placing the trade, ask who wants the opposite side, because your gain is written as their loss. As a retail trader, you are a speculator by default. Which brings us to the thing that makes all of this dangerous. Leverage magnifies the move in both directions. Buying $50,000 of stock takes $50,000, while controlling it with a contract takes a deposit. Same exposure, different capital. The table sets it out. To control $50,000 of exposure, buying the stock costs the full $50,000, and posting margin on the futures costs $6,000. Then the return on the same $1,000 gain. 2% on the stock and 16.7% on the futures. Same dollars earned, 8 times the percentage, and 8 times the percentage when the move goes the other way. The sharp edge. It cuts both ways. Leverage does not improve your odds. It scales whatever the market hands you. The upside is amplified. The downside is amplified too. And when the deposit is gone, there is a margin call. Position size, rather than conviction, decides whether leverage builds or ruins you. A multiplier on outcome. Leverage is a multiplier on the outcome rather than on the odds, and it enlarges the loss exactly as much as the gain. Put real numbers on that. A 4% index move is an 80% swing on margin. One contract at $50 per point controls $250,000 of index for a deposit of $12,500. The arithmetic for one contract. Take it line by line. The index level is 5,000. The contract multiplier is $50 per index point. So the notional value is $250,000. And the initial margin is $12,500, which is 5% of it. Now move the index. Up 4% to 5,200, or down 4% to 4,800. That is $10,000 gained or 10,000 lost on 12,500 posted, which is 80% on margin either way. Those figures are an illustration, not a recommendation. Read it correctly. Margin is not the cost. It is a deposit against tomorrow's loss, and the position is the full 250,000. 5% against you, and the deposit is gone. Below maintenance, you top up or close. And size comes from the stop rather than from the margin. A 4% index move is a rounding error to an investor and an 80% swing here. Scale, rewritten. Leverage rewrites the scale of every move. Small on the chart, enormous on the account. So here's the plan. 11 chapters, built in strict order. Futures mechanics first, then options pricing, then the structures that combine them. Here's the route. It runs in 4 stages. First futures, then options, then choosing, then building. Their subjects follow. Mechanics covering contracts, margin and rollover. Fundamentals covering calls, puts and strikes. Then premium and the Greeks, sides, meaning whether to buy or sell, strike selection and open interest, and structures, meaning covered calls, spreads, straddles, and condors. The chapter ranges are marked underneath. And the note says nothing here needs the next chapter to make sense, but every chapter needs the one before it. The outcome, what you leave with. 11 chapters, in strict order, from a first contract to a full structure. You will read a contract, meaning size, expiry, and margin. You will price an option, through premium and the Greeks. You will pick a structure from your chart. And you will size the risk before entry, because every structure in the last chapter is the 4 basic positions combined. Work the order. Work the order and the hard chapters get easy, because every structure later is built from the basics. Next we start with the contract itself. You just finished chapter 1 of the futures and options module. A derivative borrows its value from an underlying asset. Futures and options exist because risk changes hands. A future is an obligation while an option is a choice. Every contract is two-sided, and leverage scales the outcome rather than the odds. Derivatives amplify whatever you feed them, and this is education rather than financial advice. Thank you for watching Trendly Lab. Next up, futures trading, covering contracts, margin, and leverage.